Okay, thank you very much for that. But let's get to the big story, the top story today, and that is the Fitch downgrade of the US sovereign rating. Prashant is now at the big wall, and he's going to take us through what happens when some event like this happens. Prashant, we've only got one precedent in the past, right? In 2011.
Well, no, that's absolutely right. As they say, the future is unknowable. All we can do is look at the past and try and decipher what happened on a certain given event and what were the effects, etc. And that is essentially what I'm trying to do here, not prophesize what lies ahead, but just look at the evidence because this has happened once before, right? Now, before we talk about what happened after the event, we have to look at what was the positioning like going into the event. So what I've done is I've just looked at, the S&P and the S&P downgrade in 2011, the Fitch downgrade, which is right now. This is 2011. That is 2023, the current one. And I have basically looked at what the Nifty, the S&P 500, the Nasdaq have done going into the event, right? So very eerily similar. The S&P downgrade in 2011 happened on the 5th of August, and this has happened on August 1st, right? I mean, so August seems to be the month of downgrades. Going into the event back then in 2011, that is December 31st, 2010 to August 5th, 2011. Actually, this is till August 4th because 5th the downgrade happened. Nifty was down 13% already before the event, right? The S&P 500 was down 4.6%. The Nasdaq was down about 3.6% or so. This year, it's completely different. Coming into this downgrade, the Nifty actually is up 9%. The S&P 500 is up 19%, and you've got the Nasdaq, which is actually up some 37% or so. So the market was weak coming into the 2011 downgrade by S&P. The market is super strong coming into the Fitch downgrade in 2023. Now let's look at what happened back in 2011. Right. So this is the same. These are the same figures. The first column, what markets going into the S&P downgrade. But after the event on the 5th of August, what did the markets do over the next 1 month? I mean, actually, it's not exactly 1 month. It's the next low, basically. But it's coinciding between 25 and 30 days after the downgrade. So Nifty was down 13% already. It fell another 11% nearly. The S&P was down 5%. It fell another 6.5%. You had the Nasdaq, which was down 4%. It fell another 8.5% back in 2011. And hence, right, now that's obviously it's got to be a question mark because we don't know. The Nifty and the changes coming into this event, the S&P and Nasdaq sort of changes, very strong returns coming into the downgrade of Fitch over the next 1 month or so. Who knows? I mean, today, of course, we are down sharply. But what will we fill those figures up with a month down the line? We don't know. Views differ, and I'll tell you there are two distinct schools of thought. One is sort of trend watchers, right? I mean, people who watch the trend, and it's a very simple argument. They say the markets sold off in 2011 after the downgrade because they were already down. The trend was down. So the way the market treats news flow in an uptrend and downtrend is different. I mean, in an uptrend, perhaps markets look through it. We see it every day with earnings, etc., etc. And on the other hand, in a downtrend, if you get bad news, the sell-off gets exacerbated. That's the first way to look at things. The second is the more skeptical viewpoint, which is simply the fact that the markets have done very well. Let's move the graphics along. That markets have done very well. Just to give you an example, they've done so well that the BSE, the NSE Small Cap Index, has not even had a 5% pullback even once since the rally began from the lows of 2020. I mean, you could say the similar thing for Nifty. You could say, actually not for the Nifty, but you could say similar thing for other indices. And they say, well, this could be an excuse for a bit of a pullback. So that's two viewpoints. I would personally, if you ask me, I would lean towards the first argument, which is, the state that the market is in, that tends to often determine how it takes a certain news flow, positive or negative. So that's, just looking at historical 2011 downgrade to see what the markets have done and what we may do from here on. We have Manish Singh from Crossbridge Capital and emerging equity markets strategist. Adrian Mowat is also joining us on the phone line. Gentlemen, great to have both of you here. Thank you very much for your time. Adrian, so just want to, I hope you've been listening in. Your thoughts on, what I've put out in terms of the data and your reading of it. What happens next?
Look, I think this is an interesting wake-up call on the fiscal position in the United States. Part of the reason that we have a strong U.S. economy is that you've got strong government spending growth this year, some 3.2% in real terms. And so that's supporting the economy, but you can't keep that going. I think the other wake-up call is for bond investors. Now, I'm hearing a lot of people saying you should buy bonds at the moment because yields today look attractive. Well, yes, they do look attractive relative to the QE post-GFC world when you had interest rates near to zero and central banks' balance sheet expanding and fiscal positions that were okay. We've now got a weak fiscal position, quantitative.
I think we've just
we dropped
lost
the line.
that line with Adrian. So let's take the same question to Manish as well. Manish, that was very helpful data that Prashant put out. How we came into the downgrade in 2011 versus where we are after a fantastic equity run. Do you think markets are going to take this a little more seriously than just a one-day, two-day reaction?
Well, that's a big question. The market should take it seriously. But let me just qualify a bit. I heard Prashant's package, and it's very, very good. Now, one has to bear in mind that when we are talking about bond downgrade, so now that two rating agencies have downgraded, because S&P downgraded US in 2011, it is not a AAA because you need two of the three agencies. So there's only one AAA country now, Germany, a large country, right? So people have moved away from tracking AAA assets. So even if you look at it from bond investors' point of view, I don't think you will see a selling because it's not AAA. So I don't see that as a big problem. It is definitely a reminder to the U.S. politicians and the U.S. policymakers that they just can't continue on the path that they are in. Though I have to agree with Treasury Secretary Janet Yellen that this is very surprising, because if you look at the statement that Fitch put out when they did warn about the U.S. position, and they said that they may have to downgrade the rating provided these three things happen, and those three things were significant and sustained rise in debt to GDP. Now, that hasn't happened. Debt to GDP is where it is, around 100%. And they also mentioned something called deterioration in governance quality. Now, a bipartisan approach to lift the debt ceiling until 2025 is not deterioration in governance quality. I mean, there is a unanimity in how the U.S. wants to work. And the third aspect was macroeconomic policy performance and prospects. I mean, U.S. has grown at 2.4% in Q2. If you look at Europe, Germany is in a recession, and Eurozone is growing at 0.3. So I don't think that, this downgrade is really I think the reason this downgrade has happened, I find it very puzzling. If you look at all the factors around, it should make people think. So if you take a 36,000 feet approach and see where you should be investing, I think emerging market bonds definitely are more attractive than developed market bonds for the reasons that Fitch and everyone has outlined, given the fiscal position, which could get worse. But that's the only thing I can draw from this. But it is not something which makes me think, you shouldn't hold U.S. asset or dollar assets or U.S. Treasury. On relative basis, in the developed market world, U.S. is definitely a far better economy in every way than any other economy in the Western world, I should say.
Manish, that point is well taken. We are back and connected with Adrian Mowat. Adrian, you were telling us, Manish was just highlighting how he's surprised, puzzled by Fitch's downgrade, and he doesn't expect meaningful selling of U.S. U.S. treasuries. But complete the point that you were earlier making.
Yes. So what I was making was I actually think U.S. Treasury yields are going to be moving higher. And this is a secular story as we move away from the QE zero interest rate world that we had post the GFC. We're now in an environment where fiscal deficits are rising, net debt issuance, particularly with quantitative tightening, is accelerating. And U.S. inflation at the core level above 4% is still much higher than the Fed wants it to be, so short rates are likely to remain elevated. And so I think fair value for U.S. bonds is probably closer to 4.25 to 4.5. And that perhaps the Fitch story gets people just to relook at this story and think about the impact of moving to a more normal yield curve and a more normal level of long-term interest rates. But, I'd agree with the comment that on a relative basis, the U.S. economy is by far the most robust major economy.
No, absolutely. Take your point. So, Adrian, I think that's perhaps the right way to look at it, right? It shines the spotlight on the debt issues, right? Which is, we all know it's unsustainable. But when do we reach that point of unsustainability? No one knows, right? Perhaps not in a lifetime, so we don't have to bother. Maybe it kind of focuses the spotlight on that issue. But for stock markets, which have done so well, Adrian, what does this mean over the next 1 month, 2 months? Because we're sitting on some pretty strong gains across the world, in the US, here in India as well.
Yes, I mean, we're looking on strong gains from October lows. If you look at 12-month statistics for most equity markets, they don't look as strong. So I caution people a little bit in, extrapolating a strong move after a very, very weak 2022. But at a sector level, I would suggest that the rotation out of tech and growth stocks into near cyclicals like financials may accelerate as you get a slightly higher long-term discount rate, and that puts a little bit of pressure on growth. And if people start to extrapolate out yields remaining higher for longer, then that's good for the financials and then net interest income.
So, Adrian, just to expand on that point, if U.S. yields move higher, like you expect them to, where does that money go? What home will it look for? I mean, we have yields moving higher in Japan as well now, U.S. There's so much going on. What about flows into emerging markets like India?
Well, remember, you're asking about where the money goes. Well, we need more money to buy U.S. bonds, which is a supply fact. The U.S. government is issuing more debt because they're running a fiscal deficit, and the Federal Reserve balance sheet is being run off. So U.S. bonds will continue to have net inflows in them. The question is, at what price, at what yield do we need to move to for those flows to be attracted? So I don't think you can spin this as money goes somewhere else, because the fact of what Fitch is saying is more money does have to net flow into U.S. bonds.
Does that impact flows into a market like India? I mean, that's what we're really looking out for. It's been it's a fantastic rally in India, backed by very solid foreign investor liquidity.
Yes, but I would suggest the way this works is that bond yields grind higher rather than having significant bond market volatility, which was a characteristic of 2022. And if that's the case, I don't see it as a particular shock to risk assets in emerging markets, and that investors will be more focused on the domestic fundamentals in India, and perhaps also at the corporate level, are we seeing enough Indian companies, beating expectations or being a bit behind expectations? And the results season in India was a little bit more mixed. And I think that's probably going to still be the main debating factor, or the main influencing factor for investors in India at this point in time.
Manish, Adrian, thank you very much for joining us and giving your insights, sharing them on this important issue for the markets. Get into a break. On the other side, full tilt on the domestic markets. Prakash Diwan, Srinivas Rao Ravuri will join in on the other side.